So when it comes to understanding stop losses, I've covered this a little bit before in the previous videos that I've made, such as the videos on how to trade US session and video how to trade London session, and basically the same with US 30 as well. I just thought I'd make another one just to clarify it, just for people that need that extra bit of clarification of how to use stop losses. So 3 general rule of thumb. When it comes to stop losses, put stops under 5-minute structure points. We're going to go through a few examples today. Put stops under wicks, like I've shown in the previous examples, but again we'll go through them. And then allow room for spread, so just move your stops a little bit further than they need to be, just to account for just getting stopped out by your brokerage. Not an ideal situation, no one actually wants to do it, but in a lot of cases it's going to save you and turn it, instead of turning a winning trade into a losing one, it will just be a winner. So without further ado, let's get into the video. For example, let's say you're coming to the trading day and you're marking out your zones, right? Basically, you mark the highs and the lows as we've gone through before. And we can also mark this zone here just because price is sort of close to it. And we can also use it as a target if need be. Simply all you'd be looking for is a break and retest above. And a break. If we push below this zone, then we'd come in here, wait for a 5-minute engulfing to then take it back up. On the flip side of that, if we break through, then we'd look for price to basically come down, ignore this arrow here, but we'd expect it to come down, tap back up, 5-minute bearish engulfing candle, and we can take it further to these lows here. Anyway, that's not what the video is about, but that is what you'd be looking for in a day like today. So, knowing what we know then, if we jump to the 5-minute time frame and just play price out, we're looking for a buy from one of these zones. All we're waiting for is a tap back in and an engulfing candle, and this is what was produced right here. So you wouldn't be in the trade until this position right here. Now from this zone, obviously you'd be in a long position. Now, there's 2 ways you can do it. Because the zone is quite small, you can have it below the zone, which also qualifies as below the structure point here. Now, price is still quite close to this structure point, so your safest bet in this trade would be having it below this structure point right here. When price opens at a structure point so close like this, I mean, it has to make the structure point itself, so it's always going to be close to it. I always target the next one below, or if we have a big zone like this, for example, let's say price is down here, and the structure point isn't till like down here, and that's your structure point, then of course by no means am I going to have my stops here. I will just have it below the zone. So you have 2 options. You can either put it below the structure point or below the zone, but just be careful and vigilant. Yes, this is below the zone, but I'm not going to have it as tight as I can possibly get, because then that just increases the chances of me getting stopped out. So I will have it below the structure point. Now in this structure point we can see a small little wick here. Sometimes they're a lot bigger. In this scenario it is only a small wick, but you would always make sure your stops are below that. And again, make sure they're a little bit lower just to account for any spreads. You don't want to be lining it up with the wick, because the amount of times price will come down here, match the wick and then push back up is quite impressive. So you want to have a little bit of leeway on it, and then you can take it and follow the trade to the upside. So if we just give a quick example here of what I'd do. So we're in the trade now. Is there any sort of targets we can look for? Yes, if we just scroll back, use the horizontal ray tool, and basically this is our first target, and this is one I would be happily going for. So if we play price on here, where do we end up? We react, and see, this is a perfect example. If I was just below the wick here, and if we just zoom in on this, you can see with spreads, you're going to be taken out of that. You're going to be taken out of the trade. But because we put our stop a little bit lower, even with spreads, we would still be in this trade and we would still be holding. So it turns maybe a winning trade into a losing one, just by trying to save that little bit of risk and try increasing your risk to reward. It actually punishes you in the long run, because you get wicks like this that completely take you out. And so yeah, we're going to continue to play price on. I haven't played it yet, but yeah, I mean, we're past 5 o'clock now anyway, but it's not too bad to close out at that, I would say. But yeah, like I say, so stops below the zones, definitely below the wicks, and below structure points. Now again, if you tried to be, you know, quote unquote, save money, get a bigger risk to reward, the reality of it is you would have been stopped out immediately. If you target the next one below, make sure you account for spreads, because like in this exact scenario, you would have been taken out by this wick here. I'm not sure how well you can see that, but you would have just been taken out. So we're going to move on to another example here, but the concepts are basically the same. So if we move on to our next example here, what we have is a US session here that we can use to trade off of, because price is right next to it. Now with this one, we can see we're in a sort of consolidating, but a little bit of an uptrend as well. So if we do get a break above, I'd like to see it carry up. On the flip side, you can see we've had heavy selling pressure. So at the same time, you could also look for I'm not too much happened there. My trading view seemed to have crashed. Anyway, to get back on track, we're either looking for a break above, tap back in, and a push back up. On the flip side, like I say, you saw that downside that we were giving. So you could see some sells from the downside. The same would be if we got a valid reaction from this bottom zone here. We could also see, if we got that 5-minute engulfing, of course, we could then see that push to the upside. And again, probably don't have to tell you at this point, but if we broke through this, got a tap back up here, 5-minute bearish engulfing, then we would still be looking for sells. So it's a bit of a mix, it's a bit of a match, but if we get a break above and a valid reaction from the top of this zone, then I want to see it take it further upside. If not, and we get a tap in and a bearish engulfing, then I want to take it to the downside, and maybe we can target a zone like this. If not, then the bottom of this zone right here. So if we jump right in, and if we can't even play price along, fantastic. So okay, I'm going to try fix this, guys, but we'll try see if we can come back to where we left off. So I'm not exactly sure what's happening today. However, we are back on track. So like I say, we know what we're looking for now. So if we play price on and we just wait for an all-important candle, we have a tap back in here and we have our bearish engulfing candle. So all we do, take this bearish engulfing candle, our stops this structure point here. Now, like I said in the last example, you can either be more risk averse, put your stops all the way above, or you can have them above the previous structure point, and most definitely above the wick. In this case, it shall be this wick right here. It's what we're putting our stops above. Unless you want to put it above the zone, then of course it would be this wick that you are trying to cover off. So basically it's the highest wick in that sort of area that you can put your stop above without your stops being ridiculously big. However, saying that, this stop is pretty huge. So then When it's like this, it would come down to you to understand if the trade is worth it. If it's, you know, for me, it wouldn't be for taking this. But if I could truly see it coming down to here, then of course I'm taking that trade every time. So it's up to you to decide, look, realistically, this is where I want my first take profit to be. Now, is this really a trade I want to be getting in if it's a 0.77? If this zone wasn't here and your only zone was here, then it wouldn't even be a thought. But as soon as you have other zones that you could potentially reverse from, as seen a few minutes before when I drew them arrows out, we could still get a reverse from this zone. Then, like I say, it's up to you to decide whether the trade seems worth it. Just for this example, I'm going to do it anyway. Like I say, risk is accounted for. We're above the wick, so if price does come up, it's basically the trade is either just wrong in the first place, but we've covered the fact that if we do get wicked, that potentially we've covered ourselves from just completely getting wicked out. And that's what we're aiming for. So we've had our entry signal, we know where to put our stops. Like I say, you can risk it a little more by putting it a little bit lower, still account for them spreads, and then if you want to go even a little lower, you can as well. Just do not get, again, greed is coming into it, don't get too greedy. Make it make sense. Is it above the zone? Is it above the wick? And is it above the wick or not? Have you counted for spreads enough, or have you tried to put it above the wick in the tiniest way like that, whether you've got this tiniest gap, or have you actually accounted for potential spreads that you may come across? And these, again, are the questions you have to ask yourself. I can only give you the blueprint. There's only so much I can give you. But if you're on a trading day trying to get away with certain things, I can't stop you from doing that. So a lot of the trading is on you. But like I say, I can give you as much and I can help you out as much as possible. But when it comes to actually trading, that's when you come in. So without further ado, let's play price on. And there we go. So that was a fortunate example. We got a little bit reaction off this zone. You see we held it for, what was that, 20 minutes? And then we just broke through. So, yeah, I mean, the concept is pretty simple with stop losses. I have it above the zone, above the wick. Well, definitely have it above the wick, because there's always going to be spreads if you're trading from a brokerage, which I assume you all are, of course. And then the last one is just have it above or below a structure point. We've seen two examples here where one was to go long, so you'd put your stop below the structure point. One was to go short, which is this example right here. The structure point is right here, so you'd put your stop above the structure point. And definitely above any wicks to account for them all important spreads. So the concept is simple. I am just going to do two for this one, just because I think it's pretty simple. However, wrong of me to assume, but if you want more videos on this, I can definitely make some more. As we go through trade examples, you'll see where I put my stop losses, and it'll all be a learning curve, and it'll help you learn that as well. So if you want more, do let me know. But for the time being, in terms of stops, there's just 3 rules. I'll just go over them one more time. Above the zone, above or below the zone, above or below a structure point, and definitely above wicks to account for spreads. Always account for spreads, and always put them above the wicks. And that is it. So try to keep it simple. Hopefully that's helped you guys out a little bit in terms of more understanding. If not, like I say, I'm more than happy to help or make another video on this. So yeah, just let me know, guys. But thank you ever so much for watching, and have a good one.